Okay, so how we marry together these two concepts, ABC patterns and the leg 1 neutralization leg 2 concept, which at the face of it are not necessarily entirely synonymous. What you want to do is consider the fact that even within the consolidation channels within price action, you will get swing points, even fairly minor swing points, that kind of serve as ABC points relative to that 4-part pattern we just showed you. So one of the first things you can do is apply basic trendline analysis with that 3 crossover paradigm on MACD to help you predict price's next move. And again, using a bias, we're not going to look for a continuation up move if a validated trendline break happening nearby is pointing us in the opposite direction. So the basic technique is consider the direction that MACD appears to be breaking. If you have a crossover happening at a C point, which way is that crossover heading? You want to look for concurrent swing points within the price consolidation channel and draw a trend line which is validated by that MACD crossover. Look for a clear break, typically a close at least 5 pips from the break point, and then apply your basic Tom DeMark style price projections to help you figure out how far price is going to go from there. So let's look at a chart illustration which fleshes this out a little bit better. This chart is a really good illustration of how we can marry together, so to speak, the concept of MACD neutralization with those ABC continuation and reversal patterns we just looked at. So as per usual practice, let's read this chart from left to right to see what's going on. First of all, we had a bullish crossover on MACD over here, validating a supply trendline break over here, after which there was some congestion, and then we had a profound up move on both price and MACD. At the point there, we got this secondary crossover heading in the opposite direction. Price really started to move sideways in this channel, and we could see then that with price sideways and MACD trending down to the waterline, we could regard this as neutralization. Now, how do we know for sure that this thing is going to continue on up after neutralization? We have an A point and a B point. Is this a C point of a continuation pattern? Yes or no? Well, the first thing we want to do is take note of a bullish tertiary crossover setting up over here. We want to consider that in conjunction with trend line analysis. So we have a swing point and another swing point, and this creates a Tom DeMark style supply trend line. And so this crossover is actually validating price breaking out beyond this trend line. And in fact, this is a different structure altogether. This is actually a wedge in an uptrend. It goes by different names, but it's really the shape that matters more than anything. So price breaks the trend line. That is validated by the MACD crossover. And so even though this is a sideways channel and not really a retracement, we do have a swing point here constituting a B point. And in and around here we have our C point, B down to C, A, B down to C before it then breaks the trend line. And as we can see, what happened thereafter, MACD headed up with angle and separation, outlining the continuation up move on price. So we're using trend line analysis. We're finding swing points within this channel or wedge structure, and together those help us outline the ABC paradigm, which confirms for us an uptrend continuation versus an uptrend reversal. We mentioned that there are a couple of different techniques in addition to trendline analysis for helping you figure out what your C point is setting up for, either a continuation or a reversal. So what we want to do is really just simply look at our other indicators. Using that 3 crossover MACD paradigm, what we want to do is corroborate the reading with similarly aligned signals from other indicators. And a good rule of thumb you might want to work with is that if 2 of the other 3 or 3 of the other 4, however many you're working with, are lining up the same way as the MACD crossover at that C point, you have a pretty strong confluence, and you have further confirmation as to which way the market's going to go next. I think we mentioned this point earlier, but it's best that you don't use three different variations essentially of RSI, and I think there's actually more than that. If you look at them, they're pretty similar, some of those guys. But you might want to consider using a volatility style indicator such as Bollinger Bands, a momentum indicator such as the Stochastics Momentum Index or Stochastics itself, 1 or more moving averages. Actually, that should be 2 or more moving averages. And then maybe just throw in a kitchen sink style indicator such as parabolic SAR, something that has nothing in common with these other guys. And if 2 out of 3 or 3 out of 4 of those guys are lining up the same way as MACD at the point where you believe you have a C point unfolding, they can help steer you in the right direction as to whether you have an uptrend continuation or reversal, and vice versa for a down move. Let's look at a chart example. Lots going on in this chart, but we'll see every one of these indicators prove to be pretty handy in helping us figure out what's going to happen next. The indicators we're using here include the 50-period EMA, the blue line on price, MACD with a default 1226.9 setting, RSI with its default 14 setting, and the Stochastics Momentum Index with a default 14.35 setting down here on the lowest panel. So let's read this from left to right. We've got a bearish crossover of MACD through its trigger just about exactly on the waterline. And this is yet another illustration of that idea we talked about at the very beginning, where you can't necessarily read too much into the position or the visual qualities of a crossover event, because sometimes they look like almost nothing, yet they herald a really nice move, which is exactly what happened here. So we had the bearish crossover on MACD outlining a nice down move. We then got a secondary crossover, a bullish crossover here, coincident with RSI punching up from way deep in its oversold territory, and SMI crossing over bullish as well. So that's an interesting coincidence here that we had those 3 guys happening all at the same time. MACD then heads up towards the waterline, and at this point, before the actual crossover event to confirm the down move, we're wondering what's going to happen next. So let's just read all the indicators. First of all, we had price going into a channel. And after it came out of that channel, of course, we had the crossover. But before that, we're wondering A, B, C, question mark. Up here on price, we see a really clear signal unfolding. This 50-period EMA is just hemming price action in. Price is not penetrating it to the upside. This is really clear resistance here. That's a good signal. That's really helpful to us, because if this were a downtrend reversal, we wouldn't expect to see resistance here. We then see RSI, which poked its head above its 50 line, coming back down, closing back through that 50 line, which is not quite as good as crossing down through the overbought zone, but pretty darn good in this context nonetheless. And more striking is SMI reaching up, just about hitting its overbought zone, and then crossing over bearish. So RSI by itself wasn't total textbook here, but reading all of these events simultaneously, you had a pretty good idea, especially after this red histogram bar painting in, confirming the crossover, that we're not thinking about a downtrend reversal. We're definitely thinking about a downtrend continuation. So we got an A point here, a B point just before this channel kicked in, and then up here, more or less at the top of the channel, we could regard that as our C point. And if we were doing a leg 1, leg 2 price projection, a measured move projection, we would use actually the swing high in the channel as our reference. We'll get to that later. But in any event, there's how we can use multiple indicators together to confirm an A, B, C downtrend continuation in conjunction with a bearish MACD crossover. When we're looking at MACD neutralization and we're wondering about this reversal versus continuation concept, there are a couple simple rules we can apply in using trendline analysis to help us figure out the situation. A simple rule is to consider the trend on the next higher time frame, and if it remains valid, if it remains in force, then the MACD neutralization on the lower time frame is more likely to yield a continuation setup. There's an exception for every rule, but that's a good working rule of thumb we can consider. Another simple rule is if the trend on the next higher time frame is weakening, flagging, waning, equivocating in any way, then that MACD neutralization we're looking at in conjunction with an ABC might be more likely to yield a reversal setup if there are other indications of that on that time frame in which the ABC pattern materializes. So again, this is kind of rehashing other information we've already looked at, but pairing together, say, a 15-minute versus a 60-minute as your quote-unquote next higher time frame, or a 60-minute versus really a 2 or a 3 or a 4-hour chart, a 4-hour chart against a daily, and so on and so forth. There are two methods we're going to use for monitoring trend on a higher time frame. This is a reiteration of earlier material. We're looking at higher level exponential moving averages such as the 100 or 200 period or the Guppy system, and then returning to this concept of a 2-panel MACD using either a slow or a fast setting. So we'll take a look at a chart example that demonstrates this concept. Here we've got a 15-minute chart on the left paired with a 60-minute chart on the right. And what we're going to do again is use the trend monitoring or trend following indicators on the higher time frame to help us figure out which way we think that this ABC pattern is going to unfold, whether it's more likely to expect a downtrend continuation versus a downtrend reversal. So what I'm going to do, just to line this up a little bit better, I've got vertical lines drawn on both panels lining up time frames. So concurrently, we're in this 15-minute candle to the left, and that lines up with this 60-minute candle on the right. That's the exact same time frame if we were trading the live edge of trading. So let's look at the 15-minute candle. We had, or 15-minute chart, I should say. We had an initial down move, and then we had our secondary crossover, a bullish crossover below the waterline, and then subsequently price went into a sideways channel and MACD neutralized right on up to the waterline. But in the live edge of trading here, we're not seeing a crossover unfolding just yet, but we really need to anticipate what's going to happen. So how do we do that? Well, let's look at our trend followers here on the 60-minute at this candle. The 200 period moving average, the gold colored line, is trending down. The red 100 period moving average is trending down. There was a death cross of the 100 through the 200 period back here. That's bearish. There was a death cross of the Guppy slow moving averages, the blue lines, through both the 100 and the 200 period moving average here. Very bearish. Bearish angle and separation right to here. The Guppy fast moving averages had gone bearish a long time ago and were remaining bearish. There's a little bit of a curl here, but not much. So if we were looking even on the live edge of trading without the benefit of all this subsequent hindsight, we saw nothing but purely bearish trending signals on the 60-minute time frame. The slow MACD was still trending down with robust angle and separation. Fast MACD had crossed over in this oversold scenario here, but that was the lone voice of dissent. All of the other indicators on the 60-minute chart were telling us stay short for the time being. Now, I can't tell you the significance of this low here without having done some pivot analysis, some prior price projections, and so forth. But we can see it. It looks, just from eyeballing it, on a 60-minute chart from here down to here, I would presume that's quite a few pips. So anyway, we look at the 60-minute chart, and the signals are almost unanimously very bearish. So looking back at our 15-minute chart concurrently, would I naturally be expecting a downtrend reversal at this point? No, I absolutely would not. It's not to say that one could not unfold, but as far as establishing a bias that I think I'm going to trade off of, I'm expecting a downtrend continuation. I'm waiting on the edge of my seat for MACD to cross through the trigger here, confirmed by this histogram bar, and once I saw that, I was going short. So that's a pretty concise example how you can read trending indicators on a higher time frame to help you figure out whether you're going to see a downtrend continuation or a reversal. The leg 1, leg 2 paradigm is one of the more popular so-called measured move methodologies. A measured move not only gives us the future direction of price, but also the magnitude of that move, how far it goes. Leg 1, leg 2 is really, it's just a simple application of the ABC paradigm. These are virtually one and the same, I believe. I don't see anything different about it. In a nutshell, what's happening is that price will move up or down as flagged by a primary MACD crossover. It completes a leg up and then it or down, and then it retraces, and that is flagged by a secondary MACD crossover. Then one or more reversal signals will identify the completion of the retracement, and a 50 Fibonacci is a perfect example of that. Then we'll get the tertiary crossover lining up the same way as the primary crossover. We've already seen this in prior examples. But the uniqueness of this particular application is that the second leg, the leg up after the retracement in an up move, it will equal the size of the first leg, sometimes roughly, sometimes exactly to the pip. When you see that, it's just kind of eerie that it's just the exact same size of the move. And what we do is we measure that move from the C point in the ABC pattern, and that will give us the target for the next leg up in the move. So let's take a look at a chart example of that now. This chart demonstrates the leg 1, leg 2 concept very well. From blue line to blue line, we have an up move. We don't know that it's a leg 1 or part of an ABC or anything at the time it's unfolding, but we watch price action and we see what it does next. So we have a bearish crossover in conjunction with what looks to be a hanging man or inverted hammer candle, a reversal candle up here. Not a stunning reversal setup, but nonetheless price falls off. Actually, if we wanted to be completists, we could have taken note of negative divergence on MACD and the histogram to price here. So those are three signals suggesting short action, downside action. And so by the time price comes down to this level, we're looking at an A and a B and a C question mark. Now, one of the things we could have done was drawn a Fibonacci here. Anytime you have a rally and price action falling off, you can do that. I didn't even have to draw the Fibonacci because if you just consider the fact that this orange dashed line is falling exactly 50% of the way through this this A to B segment, that tells you, just from eyeballing it, this is a 50 Fibonacci. And that's occurring at exactly the moment at which price is breaking a supply trend line, which is validated by this bullish MACD crossover. Now here, MACD did not exactly neutralize. It actually penetrated this waterline fairly clearly and went into an oversold situation. So we're deviating from the neutralization concept a little bit, but again, this is real life we're dealing with, so it doesn't always unfold according to the textbook paradigms. And we have to adapt appropriately. So A, B, now it's not C question mark, it's more like C exclamation mark, and that would probably be underscored by consulting a higher level time frame, and I bet you dollars to donuts the moving averages would be trending upwards even despite this pullback or retracement here. So if we had confidence in the leg 1, leg 2 concept, what we would do is draw on our price projection, which is just simply achieved by copy and pasting this red line segment here outlining the A to B move, and we would extend it up from the C move, from the C point. And that would give us a projection up to this second orange dashed line. Now interestingly, price came up initially part of the way, didn't quite make it, started to fall off. It came back and kind of tested this B level again, interestingly enough. This was resistance. It was broken. Now it's being tested as support. Broken resistance tested as support. That's that polarity concept that you see happening over and over again. And anyway, once that test was completed, then price was free to go on up and fulfill this leg 2 projection, which it did off to the right hand side here. So if you were feeling a little nervous seeing price falling off and you just didn't clue into this broken resistance being tested as support, you could have simply at that point trailed your stop to break even and just let it run. Just either get taken out with a big goose egg or just hope for the best, I guess, that this paradigm would unfold the way it was supposed to, and of course it eventually did. So again, this isn't neutralization, but hey, in the real world, we have to adapt to different signals occurring in ways different than we expect. But regardless, these crossover events on MACD, again, just doing a really good job flagging reversal points within other paradigms, just like chart reversal patterns and so forth. So that's it for leg 1, leg 2. That's it for module 6. What did we do in this chapter of our MACD saga? Well, we defined the concept of MACD neutralization. We showed how it works after both up and down moves with both graphical representations and various chart illustrations. We related the MACD neutralization concept to the 4 types of ABC continuation and reversal patterns. We showed how you could kind of marry those together. We also showed how you could use trendline analysis to confirm what would happen next after a C point unfolding, whether a reversal or a continuation. We showed you how you could cobble together readings on other indicators to corroborate that analysis, how you could do that further with multi-level trending signals. And finally, we illustrated the leg 1, leg 2 measured move methodology and showed how MACD crossovers, even when they deviated from the neutralization concept, how those crossovers helped flag the turning points within that paradigm. So a lot of information right there. I hope you found it useful. Let's move on to Module 7 now.